So there are actually a very, very small number of circumstances in which I believe it's right to meddle with the trading system and to override it. The danger is if you're ever in a situation where you're spending too much time looking at what your system is doing and following the financial news and all this kind of stuff. All these things feed into an environment in which you're more likely to try and second guess the system and override it. That's why I don't sit at my computer all day watching it trade. I spend a lot of time setting it up so that it's fully automated and just reports to me when things look like they might be going wrong.
In every case, the accuracy of experts was matched or exceeded by a simple algorithm. Why are experts inferior to algorithms? One reason is that experts try to be clever, think outside the box, and consider complex combinations of features in making their predictions. Complexity may work in the odd case, but more often than not, it reduces validity. This is a quote from Daniel Kahneman's book, Think Fast and Slow, and it's very relevant to the conversation you're about to listen to on today's show.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kaastrup Larsen.
Welcome to Top Traders Unplugged, where my goal is to give you the clarity, confidence, and courage you need to invest like or invest with one of the top traders in the world. It is the stories that you never get to hear set out as the most honest and transparent account that I can make of what goes on inside the minds of some of the best investors in the world. Today you're listening to episode 89. If this is the first episode you've heard, you might want to go back and listen to all the earlier conversations. Before we find out who's on today's show, I want to mention that today's podcast is brought to you by Eurex. And in today's conversation, I actually learn about a brand new contract from my guest that Eurex have just launched, which my guest finds to be very useful for many investors, and which you can find out much more about by visiting the Eurex website. Today I'm talking to Robert Carver, who's both an author and a trader, and who spent a good chunk of his career at one of the biggest European systematic trading firms, namely AHL, before leaving in 2013 to write his newly released book. And by the way, if you want to read the full transcript of today's episode, just visit the toptradersunplugged.com website and sign up to receive access to all of them. Now let's get started with part one of my conversation. I hope you will enjoy it. Rob, thank you so much for being with us today. I really appreciate your time.
Thank you for inviting me, Niels.
My pleasure. Now, Rob, you're a little bit different from my usual guests, which have been hedge fund managers or CTAs running their own firms and strategies. Today, you're an author and you trade your own money, having left the buzzing world of the City of London behind. But in your new book, Systematic Trading, a unique new method of designing trading and investment systems, I think you bring such an important perspective on the systematic trading world, and you break down the components in such an easy to read way that I wanted to make an exception to my usual lineup and bring you on for an in-depth conversation on a number of topics relating to this. And for me, it's a little bit funny because when I look back at all the podcast interviews that I've done so far, It's precisely 1 year ago I made the same exception for Katie Kaminsky, who had also just published a great book on the world of trend following. So, for full disclosure, I have tried to read all of the 300 pages, but I may have skipped a few in order to make today's deadline. But from what I've read, I really recommend anyone interested in the subject to grab a copy of it, or perhaps two, since Christmas is coming up. And for those who think I'm getting paid to say this, you're wrong. This is purely a recommendation based on my assessment of the quality of the book. Now, many people in the alternative investment industry are very familiar with some of your previous employers, in particular AHL, which has been an institution in the CTA space for many decades. But before we jump into your background, I just have a simple question that I try to ask all of my guests in order to appreciate the different answers that there is to this question. It basically goes something like, when you meet people that don't know you and they ask what you do, how do you respond? How do you explain what you do?
That's a very difficult question to answer. I normally say that either that I'm a writer or that I'm an independent trader, depending on who I'm talking to and which answer I think will get the best response. But I basically do both of those things. I mean, the nice thing about trading systematically is, if done properly, once you've actually designed your system, it takes up very little time.
Sure.
And that leaves you more time for thinking and writing, which is what I actually enjoy doing more. So that's what I would describe myself as.
Fantastic. Now, at this stage, I would normally move on to my usual questions, but I want to do something a little bit different today since you have just published your book. And I can't think of a better way to kick things off than by setting the scene and you reading a little bit of, the book in order for people to get a sense of your writing style, which I very much enjoyed. So I would kindly ask you maybe to read a little bit of the preface and then a little bit of the introduction to the book, if you don't mind.
Sure. Okay. I'm very bad at making financial decisions. Like most people, I find it difficult to manage my investments without becoming emotional and behaving irrationally. This is deeply irritating, as I consider myself to be very knowledgeable about finance. I've voraciously read the academic literature, done my own detailed research, spent 20 years investing my own money, and nearly a decade managing funds for large institutions. So, in theory, I know what I'm doing. In practice, when faced with a decision to buy or sell a stock, things go wrong. Fear and greed wash through my mind, clouding my judgment. Even if I've spent weeks researching a company, it's still hard to click the trade button on my broker's website. I have to stop myself buying or selling on a whim, based on nothing more than random newspaper articles or an anonymous blogger's opinion. But then, like you, I'm only human. Fortunately, there is a solution. The answer is to fully, or partly, systematize your financial decision-making. Creating a trading system removes the emotion and makes it easier to commit to a consistent strategy. I spent many years managing a large portfolio of trading strategies for a systematic hedge fund. Unfortunately, I didn't have the opportunity to develop and trade systems to look after my personal portfolio, but after leaving the industry, I've been able to make my own trading process entirely systematic, resulting in significantly better performance. And now I'll read from the introduction.
Sure.
It was the 23rd of January 2009, and I was in my London office. Although I had a desk overlooking the Thames, I was usually too busy to appreciate the view. My day job was managing a portfolio of systematic trading strategies for a large hedge fund, but right now I was focusing on my own bank balance. Data was about to be released, indicating how the UK economy had performed in the last 3 months of 2008. It would be bad news, the official confirmation that we were in recession, but nobody knew how bad. This didn't mean extra work for me, however, since a bank of computers would adjust our clients' portfolios automatically when the news arrived. So I decided to devote some rare free time to trade my own money. With a stressful full-time job, I was not a particularly active trader, but very occasionally an opportunity came up that was too good to miss. This was one of them. In my research, I found that historically, when people's fears were confirmed by terrible economic numbers, was often the best time to buy, and this was potentially the worst news I'd seen in my lifetime. Careful analysis showed that the banks, hardest hit by the financial crisis, should rebound the most if things improved. I was particularly attracted to Barclays. I had traded for their investment bank a few years before, and their balance sheet was in relatively good condition. But I also looked at investing in the other major UK banks. In all, I was prepared to risk 10% of my portfolio on 4 banking stocks. Then the figures came out. They were worse than expected, with GDP falling by 1.5%. Barclays dropped 15% almost immediately, taking it to the lowest level I had ever seen. I waited for the market to stabilise and prepared to trade. Then I hesitated. Everything had happened as expected. I should go ahead and buy. But what if this was wrong? What if the financial industry really was imploding, as everyone else seemed to think? Panicking, I quickly changed my orders, knocking a 0 off each one, so that only 1% of my portfolio was at risk. It was one of the biggest mistakes of my investing career.
Thanks very much, Rob. It's funny when you read that, it really does take you back to that time of 2009, which was a scary time to be in the investment world. Now, this was, of course, just a little bit of a background, and I wanted to ask you perhaps to take us a little bit further back in your own career to sort of appreciate and understand how you came about ending up where you are today. So, if you don't mind, take us back even to, when you were a kid growing up. What were your interests? Were you always curious about things? Give us a little bit of color, if you don't mind.
Sure. I think it's fair to say that from quite a young age, I was fascinated with computers. I'm 41 years old, so I got a computer when I was 7.
Mm-hmm.
So I was probably one of the first generation to have access to a personal computer from quite a young age.
Sure.
This interest had developed to the point where I went to university to study computer science,
mm-hmm.
which in my naivety I'd assume would mean that I would be taught how to program computer games, which at the time I think was the career that all nerdy boys of my friends wanted to do.
Sure.
Unfortunately, the course was very dry and scientific and had too much theoretical mathematics, so I didn't complete that course. I spent a few years working in a completely unrelated industry, and then, quite by accident, came across a copy of Michael Lewis's famous book, Liar's Poker.
Yeah, sure.
In a bookshop, and I read the book, and the interesting thing is that Michael Lewis wrote this book to sort of scare people off from working in finance, but I think it had the opposite effect.
Yeah.
I know of so many people who said, "Yeah, I read Liar's Poker and it sounded amazing, and I want to get into that world and do that."
Yeah, it was a great book.
So then I became interested in economics and ended up studying economics at a university and going back. And this time I managed to complete my course. So obviously I'd found the right thing. I then went to work for Barclays Capital, an investment bank.
Mm-hmm.
And I spent a couple of years with them trading exotic interest rate options, which was an experience, but not one I would want to repeat.
Okay.
I think it's fair to say that I'm not really cut out for the cut and thrust of a bank trading floor.
What time period are we talking about now? Rob?
This was in the early 2000s.
Okay.
So,
Okay.
After the dot-com boom,
Okay.
before things got crazy again. I think also from reading that section of my book, you'll appreciate that actually, I'm not emotionally cut out for making investment decisions.
Sure.
And I actually believe that very few people are.
Yeah.
Which is why I think systematic trading is the way to go. And I'm sure we'll discuss that some more.
Sure.
Anyway, after that rather traumatic experience, I spent a couple of years doing my master's degree part-time,
Mm-hmm.
whilst also working for an economic think tank, which was a more cerebral activity and a bit of a rest from the frantic trading world.
Sure.
And then again, quite by chance, to get ahead in life, you have to have a lot of luck.
Of course.
And I've been very lucky. Quite by chance, I saw an advert in the Financial Times for AHL.
Okay.
And I knew of AHL because I'd actually worked for them as a summer intern a few years beforehand.
Mm-hmm.
And they were looking for someone who had both a financial markets background, but also an economics background, and also an interest in computer programming. And I sat there thinking, this advert has been written for me.
Exactly. Can't be many of those people around.
Exactly. So I applied for the job and got through the rather tough interview process.
Sure.
And I got the job.
Fantastic. So you joined AHL, when was that? Before the crisis?
I did, yeah. I joined in 2006.
Okay.
So a very different world from the one we live in now.
Yeah.
And I also feel, not sure if luck's the right word, but I think it's been an excellent education having spent the period from 2006 to 2013 when I left AHL.
Yeah.
Probably the most exciting period to work in the financial markets.
Sure.
Obviously, the excitement was both good and bad,
but the learning was good.
The learning was excellent. Definitely.
Yeah, no, absolutely. Now, of course, you've been very busy writing a book, and that I can only imagine how much effort and time that takes. But when you are not trading, when you're not writing, what do you like to do nowadays that sort of takes your mind off those two things?
I've enjoyed doing quite a lot of cycling. Mm-hmm. One of the reasons why I wanted to stop working, full-time capacity with the 2-hour daily commute that involved was also to spend more time with my young family.
Sure.
Those are my other interests. And in the summer, I also enjoy doing a bit of sailing.
Excellent.
I full disclosure, I was actually a world champion in one particular sailing class when I was younger. So
wow, there we are. That you are my first world champion on the show.
But that was a long time ago, and I think again, in full disclosure, I'm nowhere near as good as I used to be. So
fantastic, excellent, Rob. Now, you've written a book about systematic trading, which normally involves a lot of math and equations in the real world, but you've managed to write a book with very little math being used. So why was this important to you to do it that way?
The credit for this really has to go to my publisher.
Okay.
When I sent the first draft of my first chapter to my publisher, and he came back saying, this is great, but by the third sentence you lost me. If you want to write a book that only perhaps a few thousand people in the world can understand, then that's fine. We're prepared to do that. Obviously, there's a kind of an equation that publishers use to do with size of audience, cost of book, length of book, publication costs, and all these things kind of get factored in together. So at one extreme, you'd have a highly specialized option pricing book that might sell, in a good day, might sell 1,000 copies over its whole lifetime. Yeah, that'll cost you, 3 figures to buy. Sure. And at the other end, you might have investing for dummies, which is probably going to be $10 and could well sell hundreds of thousands or even millions of copies.
Sure.
So he said, you have to think about whereabouts in the spectrum you want to pitch your book. And I very much felt that I wanted to speak to as large an audience as possible. But then the publisher kind of came back again and said, you're going to struggle, I think, to bring your ideas down to the level where anyone on the street could understand them. So let's try and pitch it somewhere in the middle, and that's where I've tried to do it. I'm not sure how successful I've been because there's a couple of reviews on Amazon.com. One says, this is the first book you should buy when thinking about systematic trading, which another one says, you should probably read at least 10 other books before opening this one. So opinion differs as to whether it's as straightforward as you say, but I certainly did try and make it as accessible as I could and incorporate maths only when I felt it was absolutely necessary.
I think you did a great job. And by the way, having also put myself into the sort of public light with this podcast, comments and opinions and reviews, they are what they are and completely uncontrollable, and whatever people had in their mind when they wrote them, that's how it comes out. So I would focus on the good ones, even though you can have 100 good ones and one bad one, and it's the one bad one you focus on, isn't it? It's
well, that's true, but in fairness, both of those reviews were good reviews.
Sure.
It's just that they disagreed about how accessible the book was. But
sure.
I'm going to take that as a kind of sampling error issue and assume that on average I'm somewhere in the middle, which is something I'm comfortable with. So.
Yeah, no, it's a great book, absolutely. Now, I want to start sort of digging into the book a little bit, and in the beginning you start out by defining 3 types of investors, namely the asset allocating investor, the semi-automatic trader, and the staunch systems trader. I want you to tell me a little bit about each of them and why it's important to define them, but I just want to be completely open here and say I'm not English by background, so I didn't know what the word staunch meant, and so I looked it up, and there may be other people on the show today, listening and who have no idea, and so it comes out as saying very loyal and committed in attitude, and it has all of these things. So now at least I learned something new very early on in the book, which is staunch means that you are very committed to your strategy. So anyway, that was a digression here. Let's go back and you explain a little bit about the 3 types of investors as you see them.
Okay, so again, in the interest of making the book more accessible, I didn't want the book to be read by people who just purely wanted to do what would normally be thought of as systematic trading. In other words, you have some rules that look at normally technical price patterns, and then in a completely quantitative way, decide what positions you should have as a result of looking at those prices, and then make the trades often automatically. So that's what a staunch systems trader is. It's someone who has an end-to-end process with trading rules at the beginning that are completely systematic, and then a position management framework that translates those into positions and trades and does all the risk management, which again is completely systematic. And then the trading at the end, it can be automated, but the point is that you follow those trades religiously and you never deviate from them. So it's a system that could be completely automated.
Mm-hmm.
Now that's quite a narrow set of people, and not everyone is in a setup or a kind of place themselves where they're comfortable with that. And it depends on whether you're comfortable with the idea that a relatively simple, hopefully, set of trading rules can actually predict what will happen to prices in financial markets. Now, not everyone signs up to that. And I kind of identified 2 other groups of people who are out there. The first are people who think that humans are better than computers at predicting price movements. And to be more specific, they think that they personally are better at predicting price movements than simple rules are. And this is what I described as the semi-automatic trader.
Okay.
So the idea behind the semi-automatic trader is someone who still wants the freedom to say, I think that Apple is a good buy, but I should be short Google.
Mm-hmm.
But who then wants to take that opinion and put it into a systematic position management framework that will then decide how big their positions should be, what size their stops should be, when they should open positions, when they should close positions, how many positions they should have open, how to manage holistically the risk of that. Because I believe that if you have a good position management framework in place, then how good your ability to forecast, or how good your systematic trading rules are if you're the first kind of investor, is much less important.
Right.
To the extent that you can actually run simulations with completely random entries. So you basically simulate a trader who is no better than flipping a coin.
Mm-hmm.
And if you then feed that into a position management risk framework that's set up correctly, that guy will still make money.
Mm-hmm.
And that's partly because in the past we've seen trends in markets, and if you're setting up a system where you've got fixed stop losses, then they will naturally tend to pick up on trends. But it's still an interesting finding. And if you then add in trading rules that do a good job of predicting where the market's going to go, that does add performance to your system, but not as much as you might expect.
Sure.
So that's the second kind of person. Now, the third kind of person is a very miserable, cynical person who thinks that no one can predict what will happen to prices in financial markets. And I call them the asset allocating investor, because a kind of long-term buy and hold mentality is, we often say, well, you can't pick stocks. The best portfolio is to buy a selection of ETFs that give you exposure to different asset classes. And then you basically say, you know what, I've got no idea what these things are going to do. I'm just going to buy all of them. So that's a perfectly valid point of view. And I run part of my own portfolio on that basis.
Sure.
But then again, I still think there's value in using a position management framework to say, well, that's fine, but how should you account for the different risks of the different assets you're buying? How should you account for the correlations? How should you trade that portfolio? How should you rebalance that portfolio, given you've got a set of costs? So the challenge for me was to create what I call a framework, which is the sort of thing that in the middle between either a trading rule or a qualitative opinion or a stubborn, buy and hold mentality. And then that takes all of those opinions and kind of processes them in the same way and produces a set of positions. And that's what I've tried to do.
Sure. No, absolutely. Thanks for doing that. Now, Rob, many people in sort of the money management business are very focused on explaining how they do what they do in order to convince investors to let them manage part of their money. But in my opinion, a more important question is why. So let me ask you why you should start a systematic trading strategy today.
Because most people are not as good at trading as they think they are. That's pretty much it. I mean, I talk a lot in my book about what behavioral finance people and psychologists call cognitive biases. So essentially, our brains are kind of wired in a way that made sense when we were, wandering across the plains of Africa a few 100,000 years ago and trying to hunt whatever we were hunting then. When you're trying to make decisions based on complex information, those emotional biases that come through that mean you end up often doing the wrong thing. Now, I know with myself that this is true, and with the little Barclays anecdote that I read out to you,
sure,
I could read out many, many more of those bad decisions that I've made due to emotional problems. And I believe these affect nearly all people. I think the biggest bias of all is overconfidence. People think that they are much better than they are, and people think they are much better than average than they are. And only someone who thought that they were better, whatever that means, at trading than anyone else would actually actively trade the financial markets. And all the people who are actively trading the markets can't all be right. There must be some of them who are below average. And
sure.
I believe that if you use a system with relatively simple rules, you can actually overcome these biases and even exploit the biases that other people have.
Now, slightly question about sort of because we always have to sort of look at ourselves and in what we do, and early on in your book you explain why people should be skeptical about trading systems that you can buy off the shelf, or books that you can buy, or blog posts that you can read, and we all know that there's a lot of that out there, but can you maybe explain why you think your book is different?
Probably because I spend most of my book explaining how bad I am at trading and how you should be very, for example, I say a lot, you really shouldn't expect a Sharpe ratio of more than, well, the absolute maximum you should expect is 1.
Right.
And actually for other people you should expect a lot less. And actually, you should do your kind of position sizing as if your Sharpe ratio was half what you expected. And in contrast, if you're trying to sell a trading system, the natural human instinct is probably to do some kind of back test and fit this thing until you have a sharp ratio that looks attractive. And is unlikely to be realizable in real life because, of course, you've overfitted to get it.
Yeah.
But it's very hard, and I have sympathy for people who are in this marketplace.
Sure.
And I'm not saying they're bad people; they're evil people who are out to scam everybody. But it's like being in a market where you're selling cars to people, and the people who are buying your cars have no way of knowing how good the car is. They've no way of verifying, for example, what the top speed of the car is.
Sure.
And you have to say, oh, my car can go 250 miles an hour, because another guy is saying, oh, my car can do 200 miles an hour. And when people buy the car and they drive it, and it's a trading system, so of course the returns you get are random to an extent, and the car then only does 50 miles an hour or crashes, and they can't really complain because, of course, that's the way these things work. So I think anything you're reading, you have to ask yourself, why is the author presenting me this information, and what's their motivation for doing it? My motivation for writing my book was obviously to sell books.
Sure, of course.
But from a pure economic perspective, writing a book and selling it and getting a percentage royalty,
sure.
In terms of hourly wage, I'd have to sell quite a lot of copies just to get to the point where I'd be getting the same as I would working in McDonald's.
Sure.
For writing. So I am genuinely interested in educating people and trying to explain to them that they need to be more realistic.
Sure.
And that's a completely different marketplace from where you're trying to compete with people who are trying to make the most outlandish claims to stand out from the pack of people making similar outlandish claims.
No, I agree with that completely. And I think it is evident from reading your book that is the fundamental motivation. Now, you touch already upon the point about sort of the flawed human brain in your book, and you end up talking a little bit about sort of the temptation of taking profits early and letting our losses run. That's really how we as human beings are wired. Tell me a little bit more about that and what it really means when it comes to trading if you get this balance the wrong way around, so to speak, and what you found when you test these kind of human behaviors, if I can call it that.
So the natural human instinct, when you see a position rise a little bit in price that you're long, is to say is to want to take a profit.
Mm-hmm.
And this comes down to essentially that kind of strong feeling that you want to kind of lock that in. And the reason you want to lock that in is you want to prove that you're right. It's the overwhelming human emotion to prove that you're doing the right thing. It's called confirmation bias in the literature. Now, when the stock's falling, if you sell at a loss, then you're going to be proving that you're wrong. And nobody wants to do that.
Sure.
So what you actually then want to do is hang on to that position, hope it goes up in value. And as it keeps falling, of course, you have the same conversation with yourself until you're forced to sell, perhaps because you've run out of money.
Sure.
So it's really about the way the human brain is treating unrealized losses and unrealized losses differently.
Mm-hmm.
We're thinking about them differently, even though they're exactly the same thing. This kind of mindset that it's not a profit until you've sold it, and it's not a loss until you've taken the loss.
Sure.
It's completely wrong. It's very easy to think about a sort of pattern of price where it would actually make sense to buy on a small profit, and that would be if the market was trading in a small range.
Sure.
Now the problem is that most of the time markets don't do that. They trend.
Mm-hmm.
Now this isn't the time for the kind of theological argument about whether trend following is a good thing or a bad thing, but certainly in the past, and people like Winton have done tests over hundreds of years of data where it's available. Markets have in the past exhibited a behavior where they're trending.
Mm-hmm.
So, if markets are going to trend, then the behavior where you're going to sell at a small profit and cut only when you've got a huge loss, is exactly the wrong thing to do. You should do exactly the opposite of that.
Sure.
Which is what a trend following system will do. So this is a really good example of where there's a human bias in our brains creates exactly the wrong kind of behavior. And you can then write a really simple rule that not only corrects for that bias, but will actually exploit it. Mm-hmm. And if other people are doing this, then that, this trend following system will effectively be taking money off them.
Sure. Now, of course, it kind of goes into the debate that's also been about, different kind of strategies, convergent strategies versus divergent strategies. We know trend following is a divergent strategy. Then you have a lot of relative value strategies on the convergent side. And I guess, in part of your conclusion is, of course, that you should have a little bit of everything. And that's probably true. But when you did your test, from memory, you did a test with these two different rules on 31 futures contracts. What did you find in that? And if you don't remember, I have the finding in front of me.
Okay. Well, I did find that I think it was 26 out of 31 markets, or 27.
Sure.
27 out of 31 markets. A very simple rule which took losses early and let profits run.
Yeah. So
it wasn't actually a kind of classical trend following rule. It was something much simpler than that.
Sure.
Did better in 27 out of 31 markets. But, that's not a huge surprise because, firms that have been trend following futures have been profitable for many decades. So it's not a big surprise. But as you say, I'm not saying that trend following is the only way to trade.
Exactly.
It's just that this is a really nice example of where a human bias produces a behavior in the market which can be exploited by a simple trading rule.
Sure. And
there are others on the on the convergent side as well.
Yeah. No, true. And actually, you use the phrase "simple trading rules." That there are two things you kind of highlight also early on in the book, and that's the importance of having simple trading rules, but also the importance of sticking to a plan. Tell me why this is crucial in your opinion.
Well, if you're not sticking to a plan, then you aren't really trading systematically. The whole point of having a system, whether it be the full-on what I call the staunch system trader, where you're running with systematic trading rules and a position management framework, or the more qualitative semi-automatic, where you're making your own forecasts, but then putting them, kind of binding yourself into this systematic framework to actually trade and manage those positions. The whole point of that is that you gain the benefits that you can get from doing that, which you're going to lose if you start meddling with your system and making changes. This is something that everyone does, from the kind of the guy who's a retail trader who's using an off-the-shelf charting package and is looking at the signals that are coming off it and saying, well, I don't really like that signal, I'll ignore that one, I'll do this one, I won't do that one. But even in large institutions like AHL, and I'm not criticizing them specifically because I know it happens in all institutions that trade systematically, you still have debates about whether you should override the system or cut the system's risks because of something that's going on in the world. Now, the key point, of course, is if you've got a purely systematic trading system that you've back-tested, in the back-test, all kinds of stuff happened. And no one was there in the backtest to override it. The system just ran and did what it did. And assuming you were comfortable with the backtest and comfortable with its behavior and what trading it was doing in the backtest, you should really be comfortable with letting that thing run now without interfering with it, because that's exactly what happened in the backtest. So there are actually a very, very small number of circumstances in which I believe it's right to meddle with the trading system and to override it. And unfortunately, this is something that comes about with long experience. And I think the danger is if you're ever in a situation where you're spending too much time looking at what your system is doing and following the financial news and all this kind of stuff, all these things feed into an environment in which you're more likely to try and second guess the system and override it. That's why I don't sit at my computer all day watching it trade. I spend a lot of time setting it up so that it's fully automated and just reports to me when things look like they might be going wrong.
Sure.
But in an institutional setting, it's much harder when you're trading with other people's money, because you have this fiduciary duty to look after their money, and as you know yourself.
Sure.
If something happens and you don't override the system, then there's always that question of whether that was the right thing to do. So it's a culture in which it's much harder to stick exactly to what the system's doing.
Sure. I mean, it's interesting. I mean, you and I are talking, in November of 2015. And actually, I would say the things you just touched upon is very real right now in the debate of investors, which obviously I spend a lot of time talking to, because people are worried that the coming changes in interest rate environment, meaning we've gone from a bear market in bonds to from a bull market in bonds to a bear market at some point when the interest rate cycle turns, which of course we know the US Central Bank has alluded to now a few times this year already, and at some point it probably will come. And there is definitely fear out there that all of these track records that we have been able to produce and can document and show, they're not going to be worth a lot when interest rates suddenly start going up, because not many CTAs have, in this case CTAs, have traded through a rising interest rate environment. And so there is this fear that, it's going to stop working and it's now. So, and of course there is a point to it, because most testing will have been done on data for the last 30 years, 3 decades. Not a lot of people and a lot of data is available going further back. I want to sort of talk about something related to this in a second, but I just want to hear your initial reaction to this kind of concern that investors clearly have.
So my last job at AHL was managing the fixed income portfolio.
Okay, so you're well positioned to answer this.
I spent an awful lot of time thinking about exactly this problem.
Okay.
And I came to a number of conclusions. The first conclusion is people often forget that what makes we're not actually, we say, we're looking at prices, and we assume that if a bond price falls that we're going to lose money, but actually what we're exposed to is total return. Mm-hmm. So if you're owning bonds, then your total return is going to come, actually this applies to all futures, but it's going to come from both the movement in the spot price and also any carry or roll down that you're getting. Mm-hmm. And the carry or roll down essentially is sort of telling you what the market expects will happen to the spot price over the period, whatever period it is. So what that means in practice, if you're in an environment where interest rates are very low but are expected to go up, then the interest rate curve, the yield curve, will be quite steeply upward sloping. Mm-hmm. And that means that the carry you'd get on owning bonds further out in the maturity space will be relatively high. So in a nutshell, if the interest rate moves in the way that the forward prices expect it will move, you won't actually make or lose any money. It's only if the rates change unexpectedly. So if they rise too early or too fast that you'll lose money. So that's the first thing to say, is that people I think a lot of people miss that. And we did a lot of kind of simulations and tests looking at different interest rate environments, and we came to the conclusion that there wasn't as much of a problem as you might think.
Sure.
The second thing is diversify. Diversification. If you're running a CTA and 40% of your assets are in US bond futures, then you're some kind of crazy guy, right?
Sure.
And this is true, regardless of what you think Janet Yellen is going to do. You should have a diversified portfolio. So, I look at my own portfolio, perhaps 20 to 25% is in bond futures.
Sure.
And if it was more than 30%, I'd be sort of thinking, well, that seems a bit high. Regardless of what I think is going to happen to interest rates, it just seems quite high given all the asset classes that are out there in the CTA space.
Yeah.
Also, why have you got so much money just in one country? Of course, all bond prices will react to what happens in the US, but what happens in the US will be the most significant thing. So, if you've got a reasonably diversified portfolio, then your exposure to anything unexpected happening in the US should be relatively small. The third thing to say is, we were having this debate for the best part of 3 years before I left AHL,
Sure.
and it's now 2015. So this is a debate we've been having for 5 years.
Yeah.
And if you'd done any kind of meddling in that period, like reducing your exposure to fixed income, you would have been hurt.
Sure.
Because being long fixed income and also trend following fixed income has been one of the greatest trades over the last 5 years. So,
Sure.
for example, last year was an excellent year for CTAs, and most of them made most of their money in bonds, actually mostly in European bonds. But if you kind of cut your exposure in bonds too much to say just 10%, you'd have seriously missed a lot of that return.
Yeah.
So my message really is don't panic.
Yeah. No, exactly. Plus,
I mean, if you can go back to probably the last time we had an interest rate rise that kind of panicked the markets in a similar way was 1994, which was when, for example, Orange County happened. A lot of people got caught short. So, you can kind of go back and look at CTAs who were trading back then, and or look at back tests and simulations, in as much as they can be trusted, and look at what happened then. So it's not like there isn't any data at all, but and you'll see losses, of course, but they shouldn't be too large as long as you haven't exposed yourself too much to one asset class in one country.
Sure. And the other thing I would add to that, I think all your points are very good, and of course one can add one more, and that is of course that systematic traders today can be short the bonds as easy as they can be long. So there should be no bias there. But what is interesting to me is that there are a few, maybe a handful of these managers who were around in the last interest rate sort of hiking cycle. So from 1977 to 1981, for example, interest rates went up dramatically. And I can see on the firm I work for, which happened to be around back then, it was a very profitable period for this kind of trading. So to me, at least, it looks to me that when the bigger interest rate cycle is up, then I think there should be good opportunities. But when people refer to the period, as you mentioned, 1994, which was a difficult year for the CTA space, well, actually what it was a correction in interest rates going up in a much bigger down move. So to me, it was more of a counter trend situation than it was the fact that the interest rate cycle had turned. It hasn't really turned. It was just correcting against the bigger trend. Anyway, let that be for a minute. I'm gonna give you a pause to drink a little bit of tea, because I want to point out something that related to what you mentioned earlier, which was the importance of sticking to a plan. And I happened just to be sent the other day a link to an article where AQRs, which for those who don't know is one of the very big firms in our business, the founder of AQR, Cliff Asness, was recently interviewed by Bloomberg. And this is what he said about investment, success, and also in relation to Warren Buffett. He basically said that genius is still good, but more and more I think about doing something reasonable that makes sense, and then sticking to it with incredibly fortitude through the tough times. Maybe I muddled that up a little bit in my reading of it, but basically what he's saying is sticking to a plan is possibly more important than just being a genius. Now, the other thing he goes on to say when talking about sort of the quote-unquote greatest investor in the world, Warren Buffett, he says that, and this is about a study that was done about him. He said, of course they found he was fantastic, but not quite as fantastic. His track record was phenomenal, but human phenomenal. What was beyond human was him sticking with it for 35 years and rarely, if ever, retreating from it. So it goes very much to the point you made before. Now, of course, at this stage, I have to do a little bit of selfish promotion, and that is to put things into perspective a little bit. And that is with my own, the founder of the firm I work for, Bill Dunn, who's essentially been running his investment strategy for 41 years with an annual return of more than 15%, which puts him, of course, along with with our new ownership of Marty Bergen, right up with Warren Buffett. Yet you will never hear these kind of rosy descriptions in the media of how they describe Buffett's achievements. But anyway, that's a little bit of being sidetracked. But I just think the sticking to a plan and being exceptionally disciplined over the long run, I think it's such an important point for people to realize.
Absolutely. And I'll just add, I think I completely agree with Cliff to the extent that I don't think I am a genius. And therefore, sticking to a simple plan is absolutely the right thing for me to do.
Now, let's talk a little bit about the difference between a subjective and an objective system, and why objective systems in some ways are better. Can you talk a little bit about that, because you mentioned it in your book as well?
Sure. I'll probably start by telling you that often when I bump into people who know about trading, they'll say, "Oh, you do technical analysis, or are you a fundamentals trader?" And I say, "Well, mainly I'm doing technical analysis because I'm using a system that just uses price data." And then they kind of either get very excited and start talking to me about double bottoms and horses' heads and golden crosses, or they kind of back away and make the sign of the cross to ward off the evil, depending on which camp they're in. So, there's kind of this assumption that technical analysis is this obscure, almost voodoo-like profession where you kind of stare at lines on the screen and then make a judgment as to what's going to happen. Now, all these kind of classic technical analysis methods, which I would describe as pattern matching.
Okay.
Because generally speaking, there's a pattern that you have in your head, and you're looking to see that pattern, and then you make a decision on that. To me, they're all extremely subjective. Generally speaking, you can't write an algorithm that will identify those patterns. And if you try and do so, you usually won't end up with a system that is profitable in a back test. So they're subjective. They're subjective systems. There's no rules you could write down. There's no computer program you can write to identify them. They're purely in the eye of the beholder. Now, there probably are actually people who can do this, who can look at charts and see these patterns and make decisions and make money. But that's not the world of systematic trading. To be trading systematically, you need a purely objective way of identifying, given some data, what your position should be. And that means you can't use all these weird and wonderful patterns, but you can use things like moving average crossovers. You can use things like breakouts out of a range, assuming that you can identify the range with a purely objective system. And now an objective system has a number of advantages. First of all, there's a kind of, if you need to make one assumption, which is that the future will be at least a bit like the past. If that's true, then you can backtest them, and then you if the future is like the past, then you will have a system that will definitely make money. There's that repeatability there. You can also analyze the properties of the system, the risk properties, the leverage, how fast it trades, and use all these things in your system design, which you can't really do with the subjective system. So, to me at least, anyone who says that they're trading systematically, but then couldn't, in theory at least, write a computer program that would essentially replace them, isn't really trading systematically. They're doing something different.
Sure. And then, of course, there's the whole element of trust, that you have to be able to trust your system. And you have a great quote in your book where you say something like, "A system which is fully automated but not completely trusted is potentially lethal."
Yes. Yeah, that's true. There's been a few high-profile cases over the last few years of normally high-frequency trading firms who've had a problem with their software, or something unexpected has happened. And of course, they've then lost a lot of money very quickly, because that's the problem with high-frequency trading. You can get through, if you do something crazy like buy high and sell low, 1,000 times a second, you can get through a lot of money very quickly.
Yeah.
It's not just enough to, if you've got a black box on your desk and it's running and it's doing its thing, you need to be completely confident in what it's doing. Otherwise, anything, the moment it starts doing something that's slightly unexpected, you're immediately going to want to change it and meddle with it. And that's why I have a huge preference for systems that are as simple as possible. Because if a system is simple, you'll know that given something's happened in the market today, it should be buying or selling. And if it does that, then you can kind of be relaxed. Very occasionally, it won't, and then you can investigate, and hopefully there'll be a valid reason for that. But you should have something that 99 days out of 100 is doing exactly what you expect. And if you've got something that's very complicated, then it's got a lot of non-linearity in it, then that's much harder to do.
Let's shift gear a little bit and talk about the things you need to avoid when creating a trading system. Because this is actually something that I often meet when I sit down with investors, because they want to know how you, as a systematic fund manager, avoid these things. And the things I'm sort of the 3 no-nos that I think you wrote about, and that is sort of overfitting, over trading, over betting is kind of the buzzwords do you use. Maybe you talk a little bit to each and why these are things you really do need to stay away from. Okay,
so overfitting is a term most people are familiar with, although some people use the term curve fitting. So this is the situation where you're developing your trading system, and you naturally want your trading system to look as good as possible. So you kind of got a couple of ways of achieving that. One way of achieving that is just to try lots of things until you find something that looks good enough. So you might think, well, I'm going to try, I don't know, a moving average crossover, and you put it in and it does okay, and you think, well, maybe it looks like there's certain situations in which it doesn't do so well, so now I'm going to add a kind of a layer to it and change it slightly so it does a bit better in those situations, and you iterate this a few times and you end up with something that's really good. And the second way is a more quantitative way, where you do that process, but essentially in an automated way. So you do some kind of automated fitting. You have a number of parameters that describe how the trading system behaves, and then you kind of search automatically for the combination of those parameters that produces the best performance. And it doesn't really, there's no real fundamental difference between these two procedures.
Sure.
They're both incredibly stupid and dangerous. It's just that one is probably slightly more respectable than the other. So, there's a couple of motivations as to why people do this. One is, it seems harsh to call it greed, but essentially it's a desire to have a higher backtest performance than is perhaps realistic.
Right.
And that might be because, if you're working in an institution, they might say, well, don't bother coming to me unless you've got a back test with a Sharp of at least 1. I mean, that might not be realistic depending on the combination of assets and the style of trading you're doing. So you push and push until you get to that. The second reason is, I guess, comes down to overconfidence, which, I think is a fundamental human flaw that affects most people. Most people think that they should be able to get a good back test, and they should be able to make a lot more money than is perhaps realistic. So for those two reasons, overfitting is rife. I mean, it's really hard to get away from, and there are kind of three sort of ways of overfitting. Okay. If I can just go on a bit more.
Oh yeah, absolutely.
The first one is what I call explicit overfitting. So that's where you've actually got this setup where you've got parameters varying in some automated way. The other way, which is a bit more insidious, is implicit overfitting, and that's where you're not doing a formal fitting process, but you at least once look at the results of your back test and then make some kind of change. And it might be something as simple as saying, well, I'm not going to run this system on the US 10-year because that doesn't do as well as the US 5-year.
Sure.
And the third way of overfitting is what I call tacit overfitting, and that is where you only ever try things that you already know will work.
Okay.
And there is absolutely no way to get away from this, because you're not going to probably sit down at a computer and develop a trading system without having done some research or knowing something about the industry.
Sure.
And what that means is, if you plonked me down in front of a computer tomorrow with a completely blank sheet and said, right, I want you to build a trading system, the first thing I would do instinctively is probably test some rules that were trend following. I wouldn't test rules that weren't trend following, because that weren't kind of trend following with a minus sign in front of them, if you like, because I know instinctively and already that they don't work.
Sure.
And that's a form of overfitting, even though I've done no, I've not even looked at an account curve. I've done no kind of statistical optimization. It's just coming from inside my head.
Sure.
So moving on to overtrading.
Sure. Yeah. Let's talk about that.
So overtrading, I think, is the Cinderella of these three problems. It's the one that gets the least attention, and most people know about overfitting, and most people know about overbetting. But I think relatively few people have a good handle on how fast their trading system is likely to trade, and what proportion of their likely performance is probably going to be eaten up by costs.
Right.
And perhaps, also, I don't think many people have a realistic idea of how much it actually costs to trade. I mean, it's very easy to say, my commission's going to be whatever, $1 per lot, whatever it is. But obviously when you then go and execute, you're going to have to pay perhaps half the spread if you just cross the spread straight away, or perhaps more, or perhaps less, depending on how you do your execution, how large your orders are, and that's harder to quantify. I'm completely obsessed with trading costs, and one reason for that is that they are a relatively stable and controllable thing to look at. So, there's not really a lot of point in getting excited about your day-to-day performance, because that's essentially a random number. And you hope over a long period of time that will average a positive number.
Sure.
But your trading costs are much less variable, and you can kind of analyze them with relatively small amounts of data and say, well, am I paying too much? Am I paying too little? And, this is an area that I think most people just don't even think about. If I look at the number of people who are proposing that you should day trade, trade multiple times per day,
sure,
and do so with financial instruments that are relatively expensive, like spread bets or OTC retail FX. I run the numbers, and I can't make those systems work on a basis where you're trading multiple times per day, because they are just so expensive to trade.
Wow. Yeah.
It's only really with a few relatively cheap futures markets that I would be able to trade that quickly.
Sure.
So that's the second mistake that,
sure,
that I think is really endemic.
Yeah.
The third mistake, overbetting, is something that most people kind of know exists, which is essentially just very simple, taking on too much risk. So we can measure risk in many different ways, but I use the expected average annual standard deviation of returns, if you look at kind of the institutional CTA space, that number will be usually around 15 to 20, 25% perhaps. Now, if you look at the trading systems in a lot of books or on websites, or that people claim to be running, that number can be in the hundreds of percent a year. So they're running with 5-10 times as much risk as what institutional managers would consider to be prudent. And that's clearly, to me at least, way too high. Sure. And the only way you can justify that is if you have extremely high expectations of what your returns will be. So again, it all comes back to overconfidence.
Sure, absolutely. Now, Rob, we've hit the 1 hour mark, and I hope the listeners are making lots of notes from what you're saying, because it's very valuable. But I just wanted to let everyone know that actually right now we've only covered chapter 1 of your book. So that's 25 pages out of 300. So, if we're going at this rate, we're going to have probably another world record for you, and that's going to be the longest podcast episode ever produced. So I'm sure we're going to have to, and that's obviously my job, is now to focus on maybe some few headlines from the book, because I also want to try and put it into the context of some of the usual questions that we have. But this is great stuff, and very, very interesting indeed. Now, in chapter 2, you go into more of the trading rules and what makes a good rule. And also, you talk a little bit about the Sharpe ratio, which you've already touched upon, what's realistic and much, much more. So let's jump into some of these ideas. I mean, you talked a little bit about it already, but when you come up with a trading rule, there's kind of two approaches, I guess. There's one, you come up with the idea first, or you look at the data first. Tell me a little bit about that and what people should be aware of in this instance.
Yeah, so I call these two approaches ideas first and data first.
Yeah.
So I think a lot of people assume that systematic traders all use data first. So a classic data first approach would be if you used a machine learning algorithm where you get a huge amount of data and you dump it into this algorithm, and out magically comes the trading rules that you should be using. So that's one approach. The second approach is ideas first, and that would be where you have an idea and then you create a rule that sort of expresses that idea, and you then backtest that rule in a similar way. So these approaches are both kind of equally valid. They have their advantages and their disadvantages. I personally prefer the ideas first method.
Yeah.
And that might be because of my background. So, I have 2 degrees in economics. So I'm more used to thinking in terms of how the world works and that there are these kind of underlying economic drivers driving asset returns. And, that's kind of what we should be trying to capture. But also because I've seen more kind of misuse of the data first method. And more kind of overfitting. So, you have to be careful about overfitting in both cases, and it manifests itself slightly differently in each case. But I think people see data first as a kind of magic bullet. And, you get people coming along who say, well, I'm going to just use this big data method, which is the buzzword now.
Sure.
And I'm going to discover something that no one else has discovered before and will be incredibly profitable. I have a big problem with that line of reasoning. I think it's it's possible, and there are firms that probably do use things like neural network, machine learning, big data successfully, but it's probably much harder than you think it is.
Yeah. I like another quote that you have in your book, or another sentence you have in your book, and you say, profitable trading comes out of careful research done by thoughtful and knowledgeable people who seek to understand where their profits come from. And I think it goes to the point about the ideas first, that you kind of have to know, why it does what it does, so to speak.
Yeah, I mean, for me, that provides an extra layer of validation because, I like to know why a rule is profitable because it gives me more of a conviction that it might be profitable in the future, and also because it gives me an idea of what the risks might be around it. So what's it exposed to? I mean, let's take an example which is probably close to your heart, which is the devaluation of the Swiss franc in January.
Oh yeah, I remember that.
So it would have been very easy to have run a data first approach and looked at the Euro Swissy FX rate and said, this thing always stays in this narrow corridor between 120 and 125 or whatever it was. All we need to do is create a trading rule that essentially does a mean reversion between these two levels, and it will make a lot of money. It would have made a lot of money, and then in about 5 minutes it would have lost thousands of times its profits in one go. Whereas an ideas first approach would be to say, okay, well, I know that there are situations in which central banks want to keep their currency depressed, and therefore a carry rule should work because the classic, of course, being the Japanese central bank for decades now has wanted to keep the yen as low as possible. So that's why funding in the yen in the carry trade is generally works. That's the reason why that trade works. Now, if the Japanese central bank then turn around and say, well, we're not going to do this anymore, then you may well want to question whether you should carry on doing that rule. But the point is at least you can have that conversation, you understand what you're doing. Whereas if you've just looked at some data and said, well, this thing goes up and down with regularity, let's just, without understanding the reason why, which is that the Swiss central bank is desperately trying to keep the rate from breaking that threshold.
Sure.
And if you'd understood that, rather than just looking at the data first and going no further, then you hopefully would have realised that doing this trade was an incredibly stupid thing to do.
Sure. No, very true. Now, some people may have observed, and rightly so, that we live in a world of constant change, and they may wonder, systems, how can they cope with sort of an ever-changing world? Can you explain that a little bit in your usual good educational manner, then so that people don't confuse systems with being something that is completely sort of static and needs constant change in order to adapt? How does sort of systematic trading adapt?
So a key question here is, what kind of trading system do you have? So if you're running something that's trading very quickly, then you probably will want to have it adapting on a fairly regular basis.
Right.
And that's because, generally speaking, the kind of short-term behavior of markets, what economists would call a market microstructure, is something that's changing, fairly constantly, fairly quickly. So a high-frequency trading rule that worked well a year ago may well not work anymore this year.
Sure.
Now, the good news is, because you're trading so quickly, you have an awful lot of data points that you can look at, and you can actually look at 6 months of data. And 6 months of data may be, terabytes or petabytes of data that you can analyze and come up with the new kind of pattern or system that's in the market.
Sure.
Now, at the other end of the spectrum is the kind of trading that I do, where I'm essentially trying to pick up on what I think are mainly human behaviours that probably haven't changed for hundreds of thousands of years. And in that situation, you probably aren't going to want to ever change your system unless you have to. So you going to want as much data as you can to fit your system. So I'll go back to Winton, which is a big CTA. I think actually the biggest CTA still.
Sure.
Who've tried to get hundreds of years of data to sort of fit, or at least to validate that their systems worked. So it depends where you are on those two extremes. So one view is to say, yes, the world is changing, but if my trading system is a relatively fast trading system, then I can and should adapt it to cope with that change. Yeah. And the other extreme is to say, yes, the world is changing, but there are certain things about the world that I believe will not change, or at least will change incredibly slowly, and therefore I do not need to adapt my system. So it's a question of where your trading system sits on that continuum, and then you should act appropriately. So, if you appropriately means, for example, if you have got a system that's trading relatively slowly, you probably shouldn't be trying to adapt it every single year to the new world that exists,
right? Because
you don't have enough data to actually tell you statistically that the world appears to have changed. You should be using 30 years of data at least if you can. If you're using 31 instead of 30, it's not really going to change the parameters that are coming out of your fitting process very much at all.
Sure. Now, I have a question that, in a sense, I sense from you that you have a lot of experience in sort of the trend following, and you seem sort of to have certainly a liking for trend following, amongst other things. But you also talk about trend following and lottery tickets, and in both cases, there are small losses awaiting, but there are some few much bigger winners. Now, we as human beings, we love to play the lottery, but I found very few investors in my 25-year career that uses the word love in the same sentence as trend following. So do you have an explanation as to why that is, when these two things have something in common, yet they seem to be received very differently?
Yes, it is an interesting problem, because you're right. People have a strong preference for trading systems that generally make money every month, but every now and then lose a lot of money, which is the exact opposite to trend following. And I think I have a lot of emotional kind of bonding with these people. I feel like, I really understand their pain because when I look at the returns to my own system, inevitably, if I'm in a drawdown, I feel more unhappy than if it's doing well.
Sure.
And if I've had a day when I've lost money, even though I know from an intellectual perspective that this is just a random number, drawn from some unknown distribution of returns that I hope has a positive mean. When I have a down day, I feel slightly less happy than if I have an up day. And if I had an up day every day for 6 months, then I'd be much happier. And so I have a lot of sympathy for that point of view. I think the sort of reason for that dichotomy between this emotional response and the emotional response to buying lottery tickets is to do with the size of the pain and the size of the payoff.
Right.
So, if you've invested all of your money into a trend following fund, you lose money for 2/3. Let's take an extreme example. Two out of every 3 days you're losing money.
Right.
You could be losing, maybe 0.5% of your net worth 2 out of 3 days.
Sure.
Whereas no one's probably going to buy that many lottery tickets. If I was to buy enough lottery tickets that it would represent 0.5% of my net worth, that would be quite a few lottery tickets. So the size of
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.